There's a chart that should not exist. For 40 years, through every recession, every crisis, when the Federal Reserve cut interest rates, long-term bond yields fall. That's the rule. That's how the system works. That's how it has always worked until now. Since the Fed started cutting in 2024, 10-year Treasury yields have been rising, not falling. Bloomberg calls this an unusual disconnect, but this isn't a disconnect. This is a message. A signal from the deepest financial market in the world. We no longer believe the system can stabilize itself. When long-term yields rise during rate cuts, it means one thing. Investors are demanding more compensation to hold US debt because they see more risk ahead. It means confidence is slipping not just in the Fed, but in the foundation underneath the entire monetary system. This chart is the spark. What follows is the fire. And once you understand why this is happening, you'll understand why 2026 is the end game. September 2019, the system malfunctioned. Banks refused to lend to each other overnight. Repo rates exploded in a single day. The repo market broke. This was the first warning sign, a system that could no longer function without cheap liquidity. The Fed stepped in immediately, emergency lending, expanded its balance sheet. Months before the pandemic, the first crack had already formed. Then the pandemic hit, and instead of repairing the crack, the Fed drowned it. Over $4.8 trillion were created in months. Markets recovered instantly, confidence returned, but liquidity does not fix structural imbalance. It only buys time. The weakness stayed, hidden, pressurized, waiting. In 2022, the Fed tried to reverse course. Quantitative tightening began, draining liquidity from the system. Over 3.5 years, the Fed removed $2.4 trillion from its balance sheet. Inflation cooled, headlines celebrated. But beneath the surface, the pressure was back. Overnight borrowing, SOFR demand, rose month after month, year after year, until it turned into a vertical line. This wasn't a spike, this was dependence. A system that needed more liquidity every single night just to function. And while the plumbing strained, the global foundation of the dollar quietly shifted. Bloomberg warned American assets no longer inspire the same confidence, structural forces that kept the dollar dominant or reversing. Foreign buyers, China, the Gulf, emerging markets, stepped away from US debt. The world that once absorbed America's deficits was disappearing. The old engine was failing. Then came 3 alarms back to back in the first week of December. The first alarm, Federal Reserve quietly injected $25 billion in liquidity overnight. The second alarm, US Treasury executed a $12.5 billion buyback of distressed bonds. The third alarm, and the biggest of all, SOFR borrowing hit an all-time high, $3.45 trillion overnight. These are not random events. These are the predictable consequence of a bond market losing faith. A bond market that already sent the message in the opening chart. When yields rise during rate cuts, the government has to intervene to stabilize funding costs, prevent disorder, and stop a liquidity cascade. This is why the buybacks happened. This is why the injections happened. This is why SOFR exploded. And then came the clearest signal of all. QT officially ended. QT only ends for one reason. The system can no longer tolerate liquidity being drained. For decades, the US enjoyed a global privilege. China sells goods, earns dollars, buys treasuries. The Gulf sells oil, earns dollars, buys treasuries. America gets cheap loans. Endless demand, infinite liquidity. But that mechanism is failing. Foreign demand is collapsing, trust is eroding. Less foreign demand, more internal stress, SOFR explosion. QT didn't end because inflation fell. QT ended because the world stopped absorbing US debt, forcing the Fed back in. Now the Fed is planning to buy around $40 to $45 billion in T-bills every single month in 2026. Why? Because in the last 12 months, the US issued $25.4 trillion in Treasury bills. Short-term debt that must be rolled every few weeks. Today, nearly 70% of all Treasury issuance is short-term. America is funding long-term obligations with debt that expires almost immediately. It's like paying your 30-year mortgage with a credit card that resets every 30 days. This shift has one consequence. When interest rates rise, US interest costs don't rise slowly, they rise instantly. This is the root of liquidity stress. This is why SOFR is vertical, and this is why in 2026 the Fed must return as a permanent buyer of short-term US debt. This is the trap. In 2008, the Fed bought to stop a crisis. In 2019, to repair a plumbing failure. In 2020, during a global shutdown. But in 2026, the Fed buys because the US government cannot fund itself without them. Temporary QE becomes structural QE, and this is the beginning of the endgame. So, what happens in 2026? Here are 4 predictions. DXY or the dollar index falls to 75 to 80. As yields unanchor and liquidity rises, the dollar loses its scarcity premium. Prediction 2. SOFR surpasses $5 trillion per night. Liquidity injections don't fix the demand, they fuel it. Prediction 3. The Fed balance sheet expands by another $500 billion to $1 trillion, just to keep fractures from spreading. And the final one, the dollar's global reserve share falls below 50%. From 72% in 2000 to 58% today, to a level where dominance becomes impossible. Bloomberg wrote, the era of easy foreign savings flowing into dollar assets is ending. And once that era ends, the dollar remains important, but no longer supreme. For 80 years, the US dollar has been the anchor of global finance. But reserve currencies do not collapse. They transition, slowly, quietly, inevitably. And today, the world is no longer stabilizing around the dollar. The system is now being forced to stabilize the dollar through trillions in overnight borrowing, treasury buybacks, permanent Fed purchases. This is how dominance fades, not with a crash, not with a replacement, but with a gradual shift away from a currency that can no longer stabilize itself without intervention. In the year 2000, the dollar held 72% of global reserves. Today, about 58%. By late 2026, it could be below 50%. Falling below 50% does not end the dollar, but it ends something far more important, the dollar's uncontested dominance. A transition from a world built on infinite dollar liquidity to a world searching for its next anchor. The signs began in 2019, they accelerated in 2020, they were ignored through 2023, they exploded in 2025. And in 2026, the world enters a new monetary era. The liquidity bubble is ending, the tightening cycle is over, the Fed's return is inevitable. The end game is here. You're watching MarketVelugu, Light on Markets.